What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies, and if you stick with me towards the end of today's video, I've got 3 additional trade ideas to share with you, so definitely stay tuned for that. As always, anything that we are associated with is linked down below in the description, and without further ado, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do, we've got a bit of a complicated candle here on this weekly bar. Reason being is that the lower wick kind of throws things off. It's not quite large enough to classify this as a hammer candle, especially in relationship to the size of the candle body, but it is important from a location perspective underneath the prior week's low. We'll talk about why momentarily, but overall, I would say that we did close fairly weak down towards the lower third of the weekly range, and we've also got a little bit of an upper wick indicating a failure from the buyers at the highs of the weekly range. So overall, in a vacuum, if you were looking at just this candle all by itself, the sellers do have a bit of an upper hand here. But again, let's think about location and context. Technically, we did breach the prior weekly high for a new higher high being produced on the weekly bar. We did the same thing at the lows. We technically breached the low and formed a new lower low. Just like we described in that upper wick a failure from the buyers, we've also got a failure from the sellers to materialize underneath the prior week's low as well. Technically, we close right back here inside of the green-bodied bar the week prior. So overall, I think we're left with more questions than answers when we're specifically looking at this section of price action right here. Don't get me wrong, in the grand scheme of things, we've got high, we've got lower high, lower high, lower high. Could this just possibly be a big lower high? Absolutely, but I would at least ask you to consider, is it possible that this to this could be the first higher low? Certainly a reasonable possibility that we'll build the case for during today's video. Before we continue to the daily time frame, let's take a quick peek at our volume profile. And what I would point out is that we perfectly rejected right off of the overhead high volume node. So it is a very important lower high that was put in here if we hold underneath that level. And as we know, it's SPY 390 roughly. We'll talk about it on the daily momentarily, but that's a very good place structurally for a lower high to be put in. But just like we have that level, we've also got the high volume node underneath us, which is where the lower wick pierced through and we closed back inside of in between these two ranges. So I would say what we want to watch for here on the high volume node perspective is how do we resolve this box? Buyers are obviously content overhead because we've got a low volume void to travel through into our next volume target up around 420, and sellers are content underneath the bottom there, which by the way, I'll just remind you one more time, they failed into the end of the week, right? If we rotate underneath it and confirm with a weekly close underneath, then again, would it be reasonable to come in for the great reset through this low volume void? Certainly would seem reasonable. Again, I'm not advocating for this, and I'm not advocating for this during this upcoming week's worth of trade. I'm just pointing out where there's structure from a volume perspective. Overall, if we're inside of this box, I think that the weekly is unresolved, and you have to at least keep an open mind to the possibility that we could be building out a higher low. Let's drill on down to the daily time frame chart now and see what we've got from a levels, psychology, and structural perspective. First thing is first, as always, let's talk about the weekly expected move here. If we are contained by the upper edge of the weekly expected move, we would be producing a very nuanced, but it is there, lower high from the daily time frame perspective, bearish. If we're contained by the lower edge of the weekly expected move, it would be a lower low underneath the prior week's low that we were just talking about in that lower wick, which is also bearish. So weekly expected move does fall into the bear category. If we do rotate towards the top, I would at least make the argument that poking through it a little bit at least neutralizes things with an equal high. But from the daily trend perspective, let's not forget that we've got low, higher low. This is still starting to build out a reasonable area for a higher low. Now you might be saying, Matt, you were pounding the table about SPY 372 in your prior videos. Where did it go? I would encourage you to adjust it lower slightly, 75 cents, which is really nothing in the grand scheme of the volatility of this marketplace, to 371.25. Reason being is that if we consult the hourly time frame chart, Notice that that is where the intraday reversal happens on the Friday session, and we have many more data points around this area as opposed to 372. I think it is the much more pertinent and relevant to this week's price action level to be using. So 371.25. What are the objectives of the bulls and the bears for this upcoming week? Obviously, we've got the overhead 50 SMA here. If we can crack this level, 378.50, that triggers a daily buy over the hammer candle high after a proven reversal intraday off of 371.25 for a daily higher low. That starts to make me think, okay, we're rotating here for at least an equal high. A higher high would be ideal to afford the next higher low pullback and continue the daily uptrend. That's the bullish look into the early parts of this upcoming week. It will not be bullish if we consolidate here for a couple of days. If on Wednesday we still find ourselves in between this range here, I think we're building out a bear flag. We should look for lower. That would align with the weekly look to rotate, off of the high volume node overhead, which is roughly here, back down towards the bottom edge of the balance. Keep in mind also that this breakdown of the flag, just because we adjusted the number, didn't really change the look from the original balance perspective. It's still the highs from here, the rejection points from here, and that's where we broke out of, right? So 371.25. Underneath that, after some consolidation, is a bear flag. And then we're looking for here, lower edge of the weekly expected move, which if you extend left, also aligns with the prior higher low, right? That would be your downside target. Over time, of course, it's the bottom edge of the original balance, which is here at 356.75. So just to sum it up one more time, bearish activity happens here. It's not neutral, it's bearish, building out a bear flag, or you could look at it as a head and shoulders pattern, break this neckline back down underneath 371.25, you rotate lower. That's bearish. If early on in the week, Monday or Tuesday, we can crack this high and put in an equal high here, or at least start trending towards that area, that checks out as looking much more bullish, and the weekly higher low being the scenario that we need to focus on going forward. That's what I've got for you from a SPY, daily analysis perspective. Remember that this is a hammer candle. We did have a strong intraday reversal off of 371.25. A couple of more perspectives to share with you here are the Fibonacci's. From the low to the high of this most recent leg higher, we did not hold the 38.2 to the T, right? We breached through it, so it's not as ideal of a pullback as it could have been, but we did hold on to the 50% retracement there on the low of the Thursday session, and we're back above the 38.2. So again, bulls want to see continued price action above that 38.2, ideally breaking 378.50 for your upside rotation to that 390 area on SPY. Bears want to see this consolidate here, break the 50%, go to the 61.8, and then the bottom of the daily balance range from here. The last Fibonacci perspective that I will share with you is if we scrunch this up and get rid of that. From the last big monthly lower high, right down to the low, we looked at this last week when we were looking at monthly charts. This went right to the 50% retracement. We backed off from that, and we are now underneath the 38.2 retracement. So remember, bears are content here, neutral in between, bulls are content overhead. Notice that your 38.2 right here is aligned with that breakout level early on in the upcoming week. 378.50, 50 SMA, 38.2 Fibonacci from this perspective. If we recapture it, it's at least neutral for the market. You cannot be overly bearish if we're above that level, in my estimation here from the daily time frame chart. So that's been an in-depth breakdown of the SPY itself. Let's take a look at the internals and see what we've got for supporting evidence. If you don't know what this is, top right-hand corner's got you covered with a brief tutorial. I will completely put out a disclaimer that Friday's data on Thinkorswim is incomplete. You'll notice that it's slightly smaller, but I will quickly put any conspiracies to bed, because we've got the data over here on TradingView. All right. So notice on the cumulative tick on Friday, it was positive, and notice that that was the true close of the volume read on Friday, up around 425 million. With this confirmation, let's go back on over to Thinkorswim and just talk about the data here. So strong inflows on Friday. This was the correct read, right? 425 million. This is starting to look much more like a flash in the pan from FOMC, right? Why, if you're a seller right now, this should make you nervous. This should make you nervous. The advanced decline line, again, positive on Friday, indicating that this volume was true. If this was down here towards the zero line, not as meaningful. Because we have a positive advanced decline line, this reinforces positive inflows on the Friday session. Remember that this tick build should be positive Overall, everything throughout the course of the week was positive or very mildly negative. Remember that a big negative read in the cumulative tick these days is like sub negative 5,000. We didn't have that. Remember, this was positive on Friday. So overall, internals support the idea that across the entirety of the New York Stock Exchange, we're actually seeing some bullish information take shape. Let's take a quick peek at the market profile. What do we see here? This is going to counterbalance the bullish take I've had so far by being slightly more bearish. Why is that? Look at where value is. Value was left lower. Oops, let's draw that in with a rectangle. Value was left lower on Friday as opposed to higher in the session overall. The point of control was left lower on Friday as opposed to higher overall. What else is bearish about this? Well, as we discussed in the Thursday video, this very mechanical level, when and if broken, would have led to a retracement through some fairly thin structure. Why were the buyers not able to break through this, consolidate up towards the highs in this area of thin structure where sellers aren't really supposed to be hanging out, and close the point of control up here? It just didn't happen. So slightly more bearish take based on the market profile. Again, if you don't know what this is, top right-hand corner's got you covered with a tutorial. A couple of other takeaways: good excess at the highs, poor low. If we violate Friday's low, it is the gatekeeper for lower, and I would expect, if tested, it to break. This is not a secure low based on what we know about market profile. All right, that's what I would say on this look. Now let's take a look through some sectors to see what other types of supporting evidence we have across the market. XLB is up first. This is the materials sector, really lightweight sector. So unfortunately, it's not going to do a whole lot for your market overall, but look at what's unfolding here. I thought it was going to be bearish for a lower high underneath the overhead supply. We closed above on Friday. Very bullish look in this chart. All of the sellers from here underwater as of the close on Friday. I would watch for this to rotate higher. Materials also being one of the more defensive asset classes, you know, it makes sense and aligns with the idea that we've been seeing a defensive rally so far in the S&P 500. If this continues higher, it's a good look, but remember, it's a really lightweight sector. Let's continue along, and we'll try to keep it brief in the lightweight sectors going forward. Real estate is lightweight, but do just continue to be mindful of the inverted head and shoulders. Watch 3750 roughly as a breakout point. The pattern can unfold, even though rates and the environment right now would support lower in the real estate sector. So I wouldn't be married to this outcome, but if it does unfold, don't be surprised. Unfortunately, again, lightweight sector, not going to be a huge push and pull for your S&P overall. Next up, let's take a look at the XLU. This is a defensive sector, and the chart looks bullish, right? So this is not a great look for your S&P 500. What I would love to see here is a break of the flag and a rejection at this prior high. 50 SMA meets us there, and then we chop around and go sideways in here. That would be a good look considering that this is D for defensive. We don't want it really, breaking out and leading the rally to the upside. Lightweight sector as well. Next up, XLF, heavier weight sector, and I'm really impressed with what took place on Friday. Remember on Thursday night's video, we were talking about the inverted hammer. It would be reasonable to breach that low and fall down for a pullback into the top of the range here at 3250. Never happened. We even pulled back into the Thursday range on the initial morning sell-off and then closed firm back above 3375. Very impressed with the buyers in the financial sector. Remembering it's a heavyweight sector, this bull flag is looking attractive. If this continues to go sideways or even break out, bullish force for your S&P 500, you're probably not going to see new lows if this is hanging out in this flag. Next up, we've got the industrial sector, 8% of your S&P 500. Same idea, bull flag. If it breaks out, bullish force for the market. Consolidation here, also bullish. Only really concerned about this if we get lows underneath 90.25. Next up, we've got the XLY, consumer discretionary, a heavyweight sector nonetheless, but lagging, certainly lagging, right? Look at this balance area. We're down towards the lows. We do have a round trip phenomenon, so lower high, equal low reattempt. I would watch for this to break down if we retest 135. The breakdown there takes you to 130. That would be a bearish drag for your S&P 500, but if the financials are at least holding up in the flag and some of the other heavyweight sectors, XLK, XLV, are holding up as well, your S&P is not going to break down if the XLI is the only one breaking underneath its range, okay? So just something to be mindful of here, but do watch for a bearish outcome in the XLY. Next up is the energy sector. What's going on here? D for defensive. We don't want to see it pushing the highs. What's it doing? It's pushing the highs. How does the chart pattern look? It does look bullish, right? Gap up, fade the gap, but respect the gap fill reversal off of 90.50, the top of the balance from the flag breakout. It would seem to me that we're looking for higher in energy, which of course is bearish for your S&P 500. So just continue to keep an eye on it. Ideally, this falls back down into the balance, rotates to the bottom on a look above and fail, and goes sideways. right? That would be the best outcome for energy in this current situation. Unfortunately, the chart looks better than that, and I do think that it does have the probability of moving higher. XLC for communications, what's going on here? Relative weakness. Is there going to be an oversold bounce, though, is the question. You don't want to be shorting this late in the game, right? The breakdown already came from the balance range here and from the balance range from this perspective here as well. With a hammer candle from Friday, big look underneath the Thursday low, close back in the Thursday range on Friday, break of the 2-day highs, probably sends you higher for a back test of 48 where we broke down from originally. Don't get me wrong, it will produce a lower high if we turn off of it, but in the meantime, as that's happening, that's bullish pressure for your S&P 500. Definitely be mindful of the dead cat bounce in the communication sector. Next up, we've got the XLK, what's going on in the tech sector, heaviest weighted component of them all. Look at what's going on here from a psychological perspective. This should be, you should be thrilled about this. A little bit of a breach of Thursday's low does not attract any new money sellers. Buyers respond. Where do we close? Outside of Thursday's range to the upside. To me, I would think that we move higher here. Oversold bounce or not, it seems to me that we would move higher here based on the failure from the sellers and the response from the buyers to close outside of Thursday's range. We've got a little bit of a gap overhead, but keep in mind, even if this rallies for a lower high, in the short term, it's still bullish pressure for your S&P 500. If we do rotate lower, I'm really only concerned with the XLK being a drag if we start getting price acceptance, not just like a lower wick down here, but acceptance underneath 116.35. All right, ideally, going forward, consolidation here or a break is the favored outcome for bullish outcomes in the S&P 500. Next up is the XLV. Sorry for skipping one there. Screen flash. XLV, healthcare sector, second heaviest weight by market cap. Very important to keep an eye on. Look at what's happening here. Again, very impressed with the buyers on Friday. Look below and fail has triggered with the close inside of the range. Now you're just watching for a daily buy setup over the hammer high to rotate to the top of the range here at 133.50. Remember, second heaviest weighted component of the S&P. Of course, that rotation would be bullish for the S&P 500. Does this chart look bearish here? Absolutely not. Absolutely not. Unless we put in a clear lower high and then break down under 128.85, that's the bear look. Currently does not look likely based on what unfolded from the Friday close. I can't reiterate the importance of healthcare enough. I don't think people talk about it. People talk about financials and tech, but healthcare is the second heaviest weight. I don't know. What's up with that, right? XLP, what's happening in the consumer staples space? Certainly a decent pullback, but look at the response. Again, no acceptance in the Thursday range, closed strong up at the highs. Is this turning into a bull flag? Certainly looks it. Reasonable higher low pullback, never made it to here. Overall, chart looks bullish to me. Remember, it is D for defensive, so if we do continue to break out and rally here, it'll reaffirm that we're in a defensive rally. We'll see that in the sector ratios momentarily, but in the meantime, it's still bullish pressure for your S&P 500. I can't reiterate that enough, how all of these charts, most of these charts, I should say, barring the XLY and barring the XLC, actually look good for your S&P 500. If that's the case, we probably hold up there for a weekly higher low, which is, obviously you guys know I'm an optimist in the market here, and you can probably tell that from my tone, but I think the supporting evidence is there as well. Let's take a look at the sector ratios. If you don't know what this screen is, top right-hand corner's got you covered with a tutorial. Here we go. Top 4, risk on sectors. XLK is in the gutter, XLY is in the gutter. We know that from the structural charts as well. XLV looks great, XLF looks great. We know that from the structural charts. With these things conflicting, you're not going to have a clean risk on upside move. Instead, you'll get more defensive rallies where you get names like industrials perking up, right? Consumer staples perking up and kind of fueling that defensive rally higher. So it's not the best look, but overall, if tech can get in gear, if the big guy here, heaviest weighted component, can get in gear and we have this pointing upwards, even if this is lagging, you'll probably have a much better bullish response in the S&P 500. Remember, industrials look great here as well. Bottom 4, risk off sectors. XLP looks good, right? This pattern typically, ascending wedge, typically breaks out. Unfortunately, it's D for defensive. It's a risk-off look. It would just, reaffirm defensive rally here in the market. Energy doesn't look great. Utilities, nice look with the start of a pullback under that 50 SMA. Want to continue to see it deteriorate here and not get some traction in the upward direction. Real estate, fine, underneath the 50 SMA as well. So overall, from a ratio perspective, you want to see the tech sector perk up. That's the main thing at this point in time. Let's take a quick look at the XLY compared to the XLP. So remember that this represents growth, this represents value. Typically, when the market is moving lower, It's because the ratio is lower. It's because growth is not being favored in relationship to value. Look at what's happening here, right? This rally takes place. This entire time the market's been rallying, this has been moving lower. So it, again, confirms that we are in a defensive rally. If this starts to perk up, that would be a bullish look. If we start to take out these lows, that's where I think things start to get concerning. And yes, this is a bearish data point for the market. So trying to be balanced, trying to be objective, this is a bearish data point for the marketplace. All right. Next up, what do I have for you? Scrolling through my list, right? Dollar. Let's take a look at the dollar. Dollar is actually bullish for the market. Why do I say that? Let's talk about the psychology of what's unfolded here, right? Technically, we had a resistance trend line. We broke that off of a rotation off of the support trend line. We should have rotated up towards this high if the trend was going to remain intact, equal high or higher high. It's not the case. So now if we re-interact with the support trend line after forming a lower high from here to here, the expectation should not be for that to hold, but rather break, which is bullish for equities. Okay, so keep an eye on the dollar during this week's worth of trade. Let's take a look at the TNX. What's going on with 10-year interest rates? They are certainly still continuing in the upward direction, but 2 days of sideways balance on Thursday and Friday. Let's zoom in on that a little bit more. So overall, as long as we're above the support trend line, probably bearish pressure for your equities here. If this starts to break down though, or at least go sideways through it, it relieves some of the pressure in equities. And I would imagine that this could either hold sideways or start to rotate in the upward direction. Remember that we talked about the divergence between what was happening in the TLT as well, right? Remember, where was it? It was right here. TLT started to indicate, let's do a little bit more accurate. There we go. TLT started to indicate a downtrend prior to the S&P 500, right? The S&Ps broke out. It was not supported by bonds. If the same thing takes place here, let's zoom in on this ever so slightly, right? We were starting to note the divergence, sideways TLT. It did break down on Friday. So what is that? That is bearish pressure for your S&P 500. What I'm trying to reiterate is that higher rates and lower bond prices will be bearish here. And as of right now, that divergence is not really playing out as well. If this remained sideways in the range and the S&P pulled back, of course, that's a better look, but it's not as of right now. Friday's close in the TLT was lower underneath that divergence we pointed out earlier, okay? So just something to point out from a divergence perspective. I've said that word too many times, so let's move on. We've got the CPI coming out on Friday. I want you to be aware of that. We will be live Thursday. I just said Friday. It's Thursday. It's all over the place this week. Thursday, 8:30 in the morning, right? CPI will be released. We'll be live at 8:15 to catch the live market reaction, but this is going to have a lot of bearing on what happens in the December meeting, right, for the Fed. As of right now, we've got about a 50-50 split between a 50 basis point rate hike and a 75 basis point rate hike. If CPI comes in hot, expect many of these participants to come over here. That would indicate a pretty firm, opinion of the market that we're getting 75 basis points as a rate hike, which would be bearish. Why would that be bearish? Because Jerome Powell did sort of forecast ever so slightly that we might start to think about slowing the pace of our rate hikes as soon as the December meeting, right? So if CPI comes in hot, it's not going to hold up. We get a 75 basis points. The market probably doesn't like that. Okay, so just something to be considering from that perspective. Let's get back on over to the platform. Let's take a look at the VIX. So VIX is right here. Notice VIX is continuing to rotate in the downward direction, and everybody's kind of losing their mind about why is the VIX moving lower as the S&P is moving lower. Just remember that as we're moving into known, well-known territory, we spent nearly a month and a half here. The VIX is not scared. Market participants are not scared of the prices that we, traded back and forth through for a bulk of September and October. Right? So this does not catch me as all that surprising. When and if the market makes a big new lower low, that's when your VIX will spike. Some people have been making the compelling argument that we can at least compare this to what had been happening in 2008. So let's look at a weekly chart of the VIX here. And all I want to point out, let's go to a weekly chart on the S&P as well. Thank you for bearing with me. We'll go, I don't even think that's going to pick it up, of course. Weekly chart, max data. My apologies. I should have had this prepared. My apologies. But what I'm getting at here, let's take a look at the 2008 case. 2008 case right here, is that the VIX spent a considerable amount of time going sideways as this downdraft was taking place. And that's what we're doing here. Going sideways as this downdraft is taking place. When and if a big new lower low starts getting made, that's where your capitulation type reads come up and over the 40 handle. I've been seeing this comparison be made in lots of channels, and I do think it's valid, right? This is a decent look for a comparison / base case for volatility. So to avoid this, what would we need, right? We would need more price acceptance in the VIX underneath 2050. Stay away from this upper range over 2050, which unfortunately has not been the case, right, over the past couple of months of trading data, past year of trading data. Let's take a look now at the VVIX. Remember that the VVIX is an indication of whether or not market participants are comfortable with this market bottom. And given the fact that we've been sideways for so long down here, yeah, nobody is really scared about, new big lower lows as of right now. If they were, they would be hedging with SPY puts, and we would be somewhere up here. That's the smart money, hedging with SPY puts. Retail, they can buy all the puts they want, but that's not going to show up in the VIX. If smart money starts hedging with the VIX and the SPY puts, that's where this will move to 103. So as of right now, I'm seeing more signs that yes, market participants are comfortable with this as being a local bottom in the S&P 500 based on the VVIX. Let's take a quick peek at the volatility futures, and all I want to point out here is that we're still in a contango, right? Look, we've got 25.50 on the current contract, and if we go out to the next major contract, which is right here, 25.79. So as of right now, yes, we are in contango. There is more risk in the future than there is in the present day, meaning that money managers should be more content with allocating capital now, right? So that would also sort of coincide with the VVIX look that we just had, indicating that yes, we are at more of a firm bottom. Let's take a look at SKEW while we're talking about volatility. SKEW is something that we brought up in the Thursday video. Remember that this measures 30-day tail risk in the S&P 500 puts. As of right now, there's not a whole lot of risk out there on the 30-day horizon, right? We're sub 113 in the SKEW. Every single time that's happened in the past, barring this one here, during a local bottom, it has marked the bottom, right? So this is a bullish data point. Even if we look at this case where the indicator wasn't exactly correct in terms of looking for a bottom, the market did tend to move higher after that experience. So again, more of a bullish data point here as opposed to a bearish one based on SKEW. I've got one more bullish supporting piece of evidence here, which is looking at new highs across the New York Stock Exchange, right? So this red line represents the start or the end of a new trend in the NYHGH. This is the new 52-week highs, right? Let's try to get those a little bit more closely aligned. So we're looking at a decent comparison. Good. So as we see a downtrend in these highs, which would indicate slowing of economic activity, companies are not pressing new highs in their stocks, right? That's where we get sort of sideways during this time frame. As we breach that trend line, that kicks off the new trend. Contraction, breach the trend line, kicks off the new trend, right? Contraction, we did technically start to breach the trend line as of like last week or something like that. So just bringing this up as a possible bullish look. It doesn't mean that the market can't roll over and spend more time lower in this ratio. It's not a ratio, but in this indicator up at the top. But as of right now, based on historical trends, it's possible that this could be the start of a leg higher. I don't know, it doesn't have to go all the way up to all-time highs, but it at least would be a positive indication, right? So that's the last sort of special chart I'll share with you on today's session. Let's get down to business in the QQQ, where we know that there is relative weakness. Hopefully this should not come as a surprise. The tech sector is relatively weak based on the impact of rates, obviously. And what I want to point out here is that there still is the rough possibility of an inverted head and shoulders, which is very ugly with this right shoulder being so low and also underneath the balance area from here. Just like in the S&P 500, we do have a hammer candle bullish on Friday that looked underneath Thursday's low, closed above Thursday's high, just like the XLK. If we can crack and recapture 266.50, I would just watch for a pop into 272. Not a whole lot more than that, but that would be a bullish look for the QQQ. And then if we can hold above, right, if something like this happens, what is that? That is a look below and fail on the daily balance range over time, target the top, right? That would align with the bullish thesis that we've presented so far, especially for the S&P 500, right? If rates kind of like cool off at least, or aren't trending as aggressively higher, that would make the case here for the QQQ as well. Unfortunately, doesn't look like it'll be that way, right? Of course, with the CPI on Thursday, some things are subject to change in that aspect. However, that's the bull case in the QQQ. The bear case is continued consolidation, just like in the S&P, building out a bear flag, looking for the equal low here, not a stretch of the imagination into 255. That would, of course, put us in store for an equal low, lower low, which would set up and keep the daily time frame in a downtrend. Wow. At a loss for words. Next up, we've got IWM, Russell 2000, and the small caps. What's going on over here? If we take a peek on a relative basis, I mean, this is clearly outperforming the S&P 500, and it's been leading the market the entire time. Remember, no new lower low on the CPI print first to break out of the balance, higher low well above the back test, and it is currently closed back outside of and above 177. So to me, if the IWM is above 177, probably not looking for all that bearish of an outcome in your SPY. Right? The QQQ is a different story because of the impact with rates, but if the IWM is above 177, I would not focus on the bear outcome in the S&P 500. If we rotate above the Friday high, which would be a daily buy setup, right? Over the hammer high, boom. Equal high here preserves the daily uptrend. You've got low, higher low, higher low, equal high, looking for continuation in the upward direction. If we consolidate and go sideways, it's more neutral as opposed to bearish here in the IWM. Breakdowns and price acceptance, so like let's say that, we're consolidating here and it's just lower wicks that pierce 177, that's neutral. Price acceptance beneath 177, definitely a little bit more bearish, but you've still got this critical support that could offer a daily higher low at 173. So if IWM is truly going to act as the leader, right now it's saying, hey, probably don't get aggressive on the short side in the S&P 500. And here's a great way to look at it. We've got the 3 side by side, and we'll just collapse that for a moment. These are weekly charts, and the white line, of course, represents these big critical levels. If the IWM holds up above its white line, and again, this has been the leader, if it holds up here, you're probably looking for the SPY to at least make it back to the white line, and you're looking for the QQQ to get closer into the midpoint of this range. I'm not saying the Qs will ever recapture this just based on IWM strength, but I'm pointing out that IWM has acted as the leader, and again, if we're above 177, probably don't want to be overly aggressive in your S&P specifically. So that's the broad market. Let's dive into the companies. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. And with that being said, we'll dive right into Apple. Look at all of this volatility here. Certainly nasty move to the downside, but I would point out it's probably not the time for a new money short, noting that we've got a 100% retracement and a big lower wick on Friday's afternoon session. So overall, I would be watching for the dead cat bounce, lower high. When and if we put in a lower high, an equal low reattempt here, that's where you want to take the short into 130. If we do rotate higher, the only long trade I would really focus on is the gap close overhead. And once the gap does close, if it closes in the first place, this would be another great place to look for a new money short, offering a big potential lower high and also respecting as resistance the top edge of the original balance range here. Next up, we've got Netflix. What's going on here? Certainly some disappointed traders that the overhead gap never closed up in this area here. Instead, we've got, again, 100% retracement. So is it time for big new money shorts? No should be the resounding answer. Instead, wait for the dead cat bounce, lower high, position into that lower high, or on the breach of the equal low for the full gap close underneath 250. Then if we accept underneath 250, if we can't put in a higher low here, then goodness, I mean, the obvious target would be 216. I'm not calling for that this week, but at least have 234.50 as a possible target within striking distance on the downside if we continue to break down. Nothing about this chart looks bullish whatsoever. Next up, we've got Tesla. Let me actually back that up. I apologize. Let me at least consider this possibility, right? If we do put in the higher low here, from here to here, watch for like a big hammer candle. If we get a big hammer candle, there might be something to do on the long side, but take it with a grain of salt. Grain of salt in Netflix, all right? So let me at least acknowledge that. Tesla, before I zoom in all the way, weekly double top, weekly bear flag, underneath this area of consolidation, right? Chart does not look great. Chart does not look great. We failed to materialize on the breakout of the possible weekly double bottom here. Never held above the neckline. We're underneath, threatening this low again. Again, 100% retracement, probably not ideal for big new money shorts here. Consolidation or a lower high, great. If it continues to break down, short on the retest of that 205.25. That's what I would watch for here inside of Tesla. Some downside targets that I've got prepared for you, 187. Then after that, there's a ways to go until 163. I'm not calling for that this week, but overall, this chart certainly looks more bearish than bullish. The only time bulls are starting to feel happy is if we can get out of this box to the upside 234, quite a ways to go. Next up, we've got Google. Again, think about the XLC and what we said there. Possibility of a dead cat bounce. The move has already unfolded to the downside. You do not want to be short in the hole here. Instead, we've got a hammer candle from Friday over that hammer high, retrace through this thin structure here. You're looking at 90.85 on an upside target. When and if we get here, yes, absolutely, you can look for the lower high and short into this, stop overhead, equal low as the target down underneath. Risk reward makes sense, but in the meantime, at least keep in mind that we can see an upswing in Google over that hammer high. I would not chase this to the downside if it continues to collapse. Next up, we've got Meta. This chart looks hideous as well. Everything in the big tech space looks absolutely hideous, and hopefully, we start to get some reasonable chart setups, but overall, I mean, just continuing the downtrend. It's like a day down, a day up, a day down, a day up. So as of right now, continuing that pattern, you would expect continued downside, right? So as long as lower highs are produced underneath 92.50, checks out as being bearish. 84 is your target underneath that. We've got 72.50, very, very historic target at 72.50. I would not be initiating new shorts if we get here, all right? Next up, we've got NVIDIA. Bullish, perhaps the only bullish chart in our lineup these days. Look at the flag that's unfolding. Oops, if we could get the drawing tool, there we are. Flag that's unfolding, breakout on Friday's session, holding above 139.50. Looks good. I'm continuing to watch for this gap close overhead and what happens when and if we get into this area. Remember that these guys play in the hardware space, which Meta announced that they're spending a ton of money on. So overall, NVIDIA chart does look good. The story and the narrative, looks good as well. As long as we're above 139.50, upsides in play. If we fall back down underneath that level, watch for continued consolidation. The only bearish outcome here would be breaking down underneath the flag lows, trapped longs liquidate, and then that moves us lower, right? So 133.50, got to stay above that in NVIDIA this week to continue this bullish narrative. Next up, we've got Microsoft. What's happening over here? Just like Google, watch for the snapback play. You want to see the lower high here at 225.80. If that happens, looking for rollover, stop overhead, short at the area, and look to retarget the equal low here. Checks out from a risk reward perspective. If you're not married with the short side for longs, more comfortable longs at least, I would want to see acceptance above 225.80, higher low, inverted head and shoulders, right? That's the only thing that I could kind of think of here. Otherwise, the trend is firmly down in Microsoft. Last but not least, the mini beast. We've got Amazon, same idea as Google, right? Long over the 2-day highs, hammer high break, daily buy setup, right? You're looking for the retest of 97. That is, if we consult the hourly chart, where we went on the FOMC volatility, right? So looking for the lower high up against that, and then the rollover if you're bearish. For bulls, it's got to be price acceptance over. Like at this point, nothing doing in bulls here until we're back over 100 at minimum. Okay, so that's what I've got for you in Amazon. And again, don't get me wrong, like scalps here, yeah, absolutely. You can take the long-sided scalp. I'm just talking from like a swing perspective. Nothing going on bullish until we're over 100. All right, so that's what I've got for you in these companies. Let's take a look at these trade ideas. Final reminder, hit the thumbs up button, the bell button, the subscribe button, all those good old buttons YouTube tells us to tell you about. Let's get right into these trade ideas. eBay is putting in a daily balance area with a well-defined top. It's a pressure cooker top in the 50 SMA. If we can crack 40.50 with a daily bar close above, we're looking for continuation in the upward direction towards 43. Not really interested in the trade if it never breaks, and obviously making a new lower low underneath roughly, I would just call it out, around 38.75 underneath this balance. Underneath there, obviously not in play either. So eBay, breakout here if the market's bullish. Next up, we've got K for Kellogg's. What's going on? 3-bar play, right? Look at that little inside doji on the Friday session. So you got 1, big continuation red, 2, inside day doji, 3, looking for a breakdown underneath 69, some targets coming from the left. I would start thinking about 67.50 roughly as a possible day trade, right? The range of Kellogg's can easily travel that over the course of one red day. Look at some of these instances here, right? So it's not out of the realm of possibility for a downswing in Kellogg's. That's the move. Not interested if we take out the inside bar high and we support here at this area of support, right? So that's what we've got in Kellogg's. Next up is Z for Zillow. Ironically, in the housing market, right? And the housing market with the rates, not thinking it's going to go so hot, but overall, look at this. Already broke out over the inverted head and shoulders neckline, and we're holding up outside of that consolidation zone here in the right shoulder on Friday's session. So again, a 3-bar play, but in the opposite direction, 1, 2. If we break those 2-day highs, look left, we're probably looking to target somewhere around 36 would be my look, right? From where this downdraft started, also prior rejection point here on the upswing. So consolidation here looks good. Breakout, anything underneath, backside, underneath the neckline of the inverted head and shoulders, not as interested. So that's what I've got for you in today's session. If you enjoyed the video or learned anything new, let me know in the comment section down below or by giving the video a simple thumbs up. Greatly appreciated. And with that being said, I wish everybody a green trading week.